sort of a double whammy this morning on global growth. Worries about Germany, the EU taking down the growth forecast there, and then the Bank of England really sharply cutting the UK growth forecast to the worst level since the financial crisis. I mean, how big of a concern is global growth versus where the market expects it?
Yeah, it's a real concern, and it's been a concern for the last year or so. And this is just yet another round of it. We've seen things like soft commodity prices. We've seen weakness in orders coming out of China. We've seen a slowdown in Europe. So all of this is consistent with the story that has been in place for the last year, which is the United States remains the strongest economy globally as far as the developed markets are concerned. And there are still weaknesses that are emerging outside our country. So you've got these two different narratives, and that's creating some of the volatility we've seen building up over the last year or so.
So does that mean, Samir, that the money should continue to flow into U.S. stocks and out of others?
You know, again, we would take a little bit of a contrarian approach. We still like the emerging markets. We think if a lot of these issues resolve themselves, whether that be trade, the Fed's patience, if there's fiscal stimulus in Europe, we think a lot of that will benefit the emerging markets. On the developed markets, if you're talking about Europe itself and the UK, we probably would be a little bit more cautious there, maybe more of a neutral stance. But we really think emerging markets are the play. Now, the US will also do well, but if we were to rank it, it'd be EM first, US second, developed markets 3.
Samir, just thinking about this big bank merger, I mean, clearly the market likes this. It's got a lot of excitement going within regional banks. Do you think it says anything about where we are in the economic cycle and the credit cycle?
You know, I think what it probably says more than anything is just I think banks are realizing that their growth opportunities will continue to be limited. And so for them, probably consolidation is one of those levers that they can pull to try and generate a few more earnings out of the kind of the existing framework and the infrastructure. And so, by consolidating, by getting those synergies, that's probably going to be a real good catalyst for the financials. And that's why we remain overweight.
Kevin, what about you? Where do you think it puts us in the cycle?
Well, the global credit cycle clearly has been led by emerging markets over the last number of years. The vast majority of global credit has been created outside our borders. So that's why it's so curious that now you're seeing a pickup in concerns outside of our borders, which is consistent with past credit cycles where they've ebbed and then flowed and then ebbed. So our concern is that the global credit cycle is easing. And here in the United States, we don't see much change in terms of credit creation, although it's slowed a little bit. So overall, we're a little bit cautious about the global credit cycle, not as concerned about the United States, but it's still worth watching.
Hey, Samir, can you help viewers understand what's happened with the dollar since the Fed pivoted to this more dovish position? And at what point does this truly become a liability for at least companies that receive a lot of revenue from overseas?
No, great question, Carl. And a lot of what's happened is basically, so the Fed has acknowledged that there is some slowness in the broader world, and that they can afford to be patient. Inflation pressures aren't really a big issue, and a lot of that has to do with the international side being as weak as it is. Unfortunately, you've had the growth expectations outside the U.S. They've been dialed down even faster, right? I mean, the ECB was going to raise interest rates this year, and now they're talking about possibly another round of bank loans. So it's not so much what the Fed's done. It's when you take it as a whole, it's that Europe has been ratcheted down even faster, and so the dollar continues to kind of have this upward bid to it. Now, we do think it will depreciate. We think there will be some stimulus outside the U.S. this year. We think the global picture does improve on a relative basis as the year goes on, which will put some downward pressure on the dollar. But to the extent that it doesn't, that question of yours about U.S. companies, I mean, they're going to face a real headwind when they bring those revenues home in euros and they translate them back into dollars.
I mean, that is a good question because the dollar's up for a 6th day in a row. Kevin, do we expect actual stimulus from central banks in Europe? I mean, we're already seeing it in China, in the UK. I mean, the Fed is patient, but that might prove to be the tightest policy in the world with global growth slowing.
Yeah, that's right, because it's all about what we look like relative to the rest of the world in terms of growth and in terms of our interest rates, and ultimately. Ultimately, we seem to continue to be relatively better than the rest of the world. One of the things I caution about, though, as far as our own interest rates here in the United States, is that the market has already taken off the table the much more hawkish posture the Fed was expressing 6 months ago. And the market began doing that back in October and November as this equity market became more volatile. So a lot of the derating, I guess, of expected rate increases, this this year has already happened. So then it leaves you with the question, well, if the economy suddenly gets much better, does that bring back onto the table the potential for a more aggressive Fed? Or the opposite would be if things get worse. We certainly don't want to see that, because that would mean negative things for equities and the economy. So you got to look at where the market has already priced, and they've already priced out significant tightening.
So where, Samir, does that leave you as far as sectors in the U.S. market? I know it's not your favorite, you like emerging markets, but in the U.S., what works?
So we still think cyclicals, right? So if you look at the parts of the economy that are continuing to generate healthy earnings growth, we think healthcare does well. We think industrials, financials, those continue to do well. We like consumer discretionary. The consumer remains in pretty solid shape. And then on the sell-off, we added to tech. We think that over time that'll continue to pervade a lot of the different parts of our lives. So we like tech more recently.